Anthony Grasso here, bringing you financial news that you can use. In this particular video, I'm going to do a stock analysis on Occidental Petroleum. Is this oil company worth investing in right now after Warren Buffett got the green light to own half of the company's shares? Well, let's find out together. I'm going to go over a summary of the company, its product offering, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps, and consider subscribe and hit that notification bell if you like to hear daily stock reviews and recommendations from an unbiased source. So let's get right into it. So as usual, this video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you get up to 12 free stocks by using my referral link in the description down below. Okay, so Occidental Petroleum Corporation is one of the largest oil and gas companies in the United States. Together with its subsidiaries, engages in the acquisition, exploration, and development of oil and gas properties in the United States, the Middle East, Africa, and Latin America. It operates through three segments: its oil and gas, chemical, and midstream and marketing. The company's oil and gas segment explores for, develops, and produces oil and condensate, natural gas liquids, and natural gas. Its chemical segment manufactures and markets basic chemicals, including chlorine, caustic soda, chlorinated organics, potassium chemicals, ethylene dichloride, chlorinated isocyanurates, sodium silicates, and calcium chloride. The vinyls comprising of vinyl chloride monomer, polyvinyl chloride, and ethylene. The midstream and marketing segment gathers, processes, transports, stores, purchases, and markets oil, condensate, natural gas liquids, natural gas, carbon dioxide, and power. Now, this segment also trades around its assets consisting of transportation and storage capacity and invests in entities. The company was founded in 1920 and is headquartered in Houston, Texas. Now, let's go ahead and look at some of the news of the company right now. So FERC, which is the Federal Energy Regulatory Commission, they approved Berkshire to request to buy 50% stake in Occidental. Now, in an order that was just made public today, it said that the authorization was consistent with public interest and subject to various conditions. Now, earlier this month, Berkshire disclosed it bought 6.68 million more common shares of Occidental, bringing its stake in the energy company to 20.2%. Now, Buffett originally made a $10 billion investment in Occidental in 2019 to aid with the company's acquisition of Anadarko Petroleum. Now, when the billionaire made this initial investment, he said it was a bet on the fact that the Permian Basin is what it cracked up to be after acquiring Anadarko. Occidental now owns 1.6 million acres in the U.S. Permian Basin. Now, why this matters is because Buffett is known to like quality companies with meticulous management and strong balance sheets. Speaking about Occidental CEO Vicky Holub to CNBC in March, Buffett said she is running the company the right way. Regardless of how effective the energy company is, though, commodity prices will determine whether the venture is a success or failure. So so let's go look at the fundamentals now of the company currently. So the company is the stock is currently trading at $70.42 a share with a market capitalization of roughly $66.9 billion. Now, the company is projected to have $36.9 billion of revenue in 2020 with earnings of $13.48 billion. Now, the revenues are projected to slightly decrease after 2022, going into 2023 and 2024. To around $30.79 billion by the end of 2024, with positive earnings around $5.44 billion. Now, if they are able to find more oil and gas in that basin, if they get approved, it could look higher than that, but that's just projections as of right now. Now, looking at some key measures of the company, let's look at the valuation analysis. Because the company is in the oil, gas, and consumable fuels industry and has positive earnings, the price to earnings growth in the PE and the price to sell ratio is the most appropriate valuation measures. The price to sales ratio is less instructive than the PEG or PE ratio since the company has positive earnings. Therefore, the company seems valued at a discount right now, with a PEG value of only 0.18 times, one of the lowest in the industry, although their PE ratio is 6.16 times, that is below the industry median of 8.41 times. Now, let's look at the profitability of this company. It's one of the more profitable companies in the oil gas industry with a net margin of 32.55%. Its net margin is among the strongest of any peer, while its operating margin and gross margins are above the medians. Now, looking at the dividend, it pays an annual dividend of 52 cents a share, and at its current stock price, produces a yield of only 0.83%. Now, this is below both the industry average of 6.22% and the S&P 500, which is 1.87%. However, there's other companies in the industry that don't even pay a dividend. Now, looking at the growth rates analysis of this company, recently the earnings trend has been positive. Over the past 12 months, the company has reversed the prior period's loss to show a profit of $10.20 per share. This performance was to be expected as the typical company in the industry posted better results. Now, they do not have high growth earnings, though, because the earnings are forecasted to decline over the next 3 years. Maybe Warren Buffett knows something that we don't about exploration, about what he found in the books, to actually say they're actually going to get a lot more revenue and earnings over the next few years. Now, they don't have high growth earnings. And it's forecast to decline over the next 3 years. So it's going to be an incline to 2022 into 2023, and then a slowly decline. Now, looking at the financial strength analysis, they have a debt to total capital ratio of around 44%, which is in line with the industry median. The company's quick ratio has a value of 0.91 times, which shows that there are not enough liquid assets to satisfy all the current liabilities in the event that operating earnings are unable to. The short-term assets do exceed both its exceeded short-term liabilities, of 9.7 billion, but they do not cover their long-term liabilities. The company's debt is well covered by operating cash flow of 67.1%. Its interest payments on its debt are well covered by EBIT of 11.7 times coverage. Now, what do the analysts say specifically regarding this company? Well, the average consensus is a buy recommendation overall, and the average price target over the next 12 months is $75.38 a share, with a high estimate of 110 and a low estimate of 52. So going over a few of the analyst reports, the Street Quant Ratings has a buy recommendation, and it's driven by multiple strengths, which they believe should have a greater impact than any of the weaknesses, and should give investors a better performance opportunity than most stocks they cover. Now, the company's strengths can be seen in multiple of areas, such as the solid stock price performance, impressive record of earnings per share growth, compelling growth in net income, robust revenue growth, and notable return on equity. Although the company may harbor some minor weaknesses, they feel that it's unlikely to have a significant impact on results. Now, the Forward Equity Research Report also has a buy recommendation on the company. It's a result of their systematic analysis of the three basic characteristics that they look at. They look at earning strength, relative valuation, and recent stock price movement. The company has managed to produce a neutral trend in earnings per share over the last 5 quarters. However, while recent estimates for the company have been lowered by analysts, the company has posted better than expected results. Now, based on operating earnings yield, the company is undervalued when compared to all the companies that they cover. Share price changes over the past year indicates that the company will perform very well over the near term. And the CFRA report definitely has a buy recommendation on it as well. The company's hostile 2019 takeover of the former Anadarko remains a gamble that looks pretty good today than it did a year ago, due to the recovery in energy prices, which could enable the company to restore its balance sheet if strong pricing persists. They also think the company has a majority stake in Western Midstream, provides more reliable gas takeaway capacity out of the Permian. Now, which is not yet an issue, but could become a factor in 2023. So let me bring it back over here. So based on all that information, am I a buy, hold, or sell recommendation on this company? Here are my thoughts. Now, the macroeconomic outlook has improved a little bit with some risk from the Omicron variant, and could give the company enough time to complete its overall deleveraging. Now, the company is aggressively paying down its debt in the near term and could be more significant exporter in the long term. The company is more attractive than the sector average in terms of both profitability and valuation. The supply-demand imbalance in the energy sector is a long-term problem, and I don't see it going away in the short term. The Anadarko acquisition was aggressive, a departure from past management style, and elevated the company's risk profile. Now, the company provided production guidance for its second half of 2022 to average approximately 1.2 million barrels per day, which is notably higher than the first half of the year. Now, higher production in the second half of the year has always been expected outcome of the 2022 plan, in part due to the ramp-up activities and scheduled turnarounds in the first quarter. So based on all that information, I'm a buy recommendation on this company. And I put a 12-month price target of $80 a share. Now, I say it's undervalued with a proven track record. Now, I wouldn't buy today because of all this good news about Warren Buffett being able to buy up to 50% of the company. I would wait till that news subsides and buy on the next dip. Now, the company definitely needs oil prices to remain high to pay off the debt and redeem Berkshire's preferred stock, which is currently holding it back from returning more cash to investors. I would reevaluate the company in about the first quarter of 2023 to see exactly where they're at with their projected future earnings and revenue projections are looking like. If they start to turn south, then I would possibly get out and take a nice little upside. Now, risk to my opinion include a significant drop in energy demand, lower than expected cost synergies, weak Permian production or pricing, or poor returns on non-core asset sales, and a credit rating downgrade. But there you have it, folks. And as always, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell to like your daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.